Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hi, everybody. I am super pumped about today's show. In 2018, I got to take a trip down to Australia and New Zealand and do a little bit of a speaking tour down there. We started in Sydney and then went from Sydney to Melbourne to Canberra to Brisbane and then up to Auckland. And in Auckland, I got the pleasure of meeting David, who's on the podcast today, and kind of talking to him about his tax firm in New Zealand at the time, kind of getting to know him and his colleagues a little bit better. And so I'm super excited to have David on the podcast. We're going to kind of nerd out a little bit and talk about U.S. tax, but we're also going to try to bring in some of the tax rules and things that about New Zealand that most people may not know, or if you do know about, maybe you've got a bunch of questions. There's what's called the FIF rules, the PI tax rules. We're going to talk a little bit about, maybe throw in some history, and anyone that knows me, I'm a huge history buff. We'll talk about why New Zealand doesn't have a capital gains tax. We'll go into some tricky areas about New Zealand trust schemes and things like that. And then we'll get into some really cool stuff a little bit later on about franking and imputation credits, the TCJA sunset, and we'll talk about maybe some new age tax is what they call it, I believe, prize winning and award taxation, kind of a little bit of a tribute there to the Olympics and some of the stuff that we saw, some of the influencer stuff that we saw at the Olympics. But without further ado, let me shut up for a second. David, why don't you tell everybody about yourself? Let's give some insight into who you are, your education, your background. Tell us about your firm, all that good stuff.
Yeah, so good morning, Mishkin. Thank you very much again for inviting me onto the podcast. Well, I say good morning, apologies. Good afternoon for you.
Good afternoon,
Of course, 8 a.m. here on the other side of the world. So thank you very much for inviting me on your podcast today. So yes, my name is David Tzimenakis, very long, complicated Greek surname. Unlikely to ever see it again, so it is quite a unique one. Yes, I am one of the managing directors of the U.S. tax team in New Zealand. So we are a U.S. tax practice based in Auckland. We primarily serve U.S. citizens who reside in New Zealand, but also a significant number of Kiwis who travel to the U.S. and residing there permanently, and which, of course, we can cover a little further on in the podcast. Some of the tax issues which they retain in New Zealand, which requires them to continue to need, say, an international tax specialist. So my background, Mishkin, I originally studied at the University of South Wales. So as you clearly guessed, I'm not from the US originally. I am from United Kingdom. Studied at the University of South Wales, and then after university, joined a major UK bank. Now, this was my first introduction to the US tax system. I received a lot of training at the bank. We were really at the forefront of the initial stages or initial warning signs of FATCA being introduced.
Oh, wow.
I did this for a number of years through the GFC, which was a very stressful time to be at a bank. Before I eventually gave it up, I needed a break from all of that. I traveled the world as much as I could for a few years before eventually settling down in New Zealand. I was almost immediately snapped up in New Zealand by another very respectable US tax firm here. And that, of course, this all led to where I am today with my own firm, the US tax team. So I don't require any professional registration in New Zealand. I've considered going down the route of CPA status here a number of times, but I've been advised by some well-respected peers in the industry that it may not necessarily be good for business because it creates competition with a very competitive New Zealand tax market at that stage. So as a result, I'm only licensed to practice before the US authorities, but that works very well given the work that we do here.
So if someone comes in and says, "Hey, I need someone to do both U.S. and Kiwi stuff for me," do you refer them out on the Kiwi tax stuff, or?
We do. So we've got a number of different partners. One main company, so JC Tax. So they're based in Hawke's Bay in New Zealand. So that's the kind of central east of the North Island. So this is a company run by Jodie Collins, former IRD. So IRD is the Inland Revenue Department.
Yep.
Former IRD agent, and now she runs a very successful practice. And we've got a very good partnership there whereby we can have the New Zealand returns prepared and the US returns prepared almost under one roof, but with a very good liaison between us both.
Okay. And for those listening, IRD, as David just explained, is going to be the equivalent of the IRS in the United States. So I'm not sure, David, what's your experience with dealing with the Inland Revenue in New Zealand? Is it a lot easier than, say, dealing with the IRS, or is it more complicated or on the same level? In my opinion, just so the folks at home know, I think the IRS is really difficult to deal with, especially when it comes to the international stuff. Probably easier to deal with on some domestic stuff, but when it comes to international, it's a very tricky process of calling in or looking online. It's a lot more. There's a lot more involvement that has to occur there to get what you need. What do you think, David?
Dealing with the IRD is a relatively straightforward affair here in New Zealand. So, of course, the US, the IRS is dealing with legacy issues, software, hardware, computer systems, which have been in place since the 1960s. And as a result, I find that communicating with the IRS, we're still dealing with fax. We have no secure mail system. This can be quite tricky, especially when you're working from overseas. In New Zealand, the IRD, luckily, we are talking about an organisation which is much, much smaller. We have a population here of only 5 million, but fortunately, governments here have seen the benefit in having a well-funded tax department. As a result, they do use quite modern technology. If let's say on behalf of a client, an accountant needs to correct something, so there was an error in their return, maybe only a minor error, they can simply log into the IRD website, send a secure mail to the IRD, and about a week later, you'd usually get a response with, "Great, thanks, we've made this change."
Oh, wow.
So it's very, very straightforward to use. But saying that, New Zealand has got it might be considered a high tax country, but there's also a lot of areas which it doesn't collect tax, where the IRS do. And this does make, maybe you might say, it makes their jobs a lot easier than your typical IRS agent.
I would assume so. Okay, let's shift gears for a second here. Let's talk about, so I'm Mish, I'm a US citizen, and I want to come inbound into New Zealand. I want to live in New Zealand. Can you talk to me about maybe the transitional residency rules or things I need to be aware of? Maybe the top most 5 common tax issues I'm going to run into. So I set my foot off the plane and I'm going to set my flag down there. Tell me, what am I going to run into?
Well, ideally, Mishkin, you would have reached out to me before you even got on the plane. It's important to get advice before you leave. And there are very good reasons for that, especially around the fifth tax system. But let's say the 5 biggest issues that affect a US citizen moving to New Zealand, which can all be dealt with, they can all be fixed, but they do need advice first. I would say the top issue, the top concern, and if you type it in online on Google, it's a top search, is KiwiSaver. So New Zealand does, KiwiSaver is the sole government sanctioned retirement system in New Zealand. Whereas in the US, you have IRAs, Roth IRAs, 401ks, a huge different number of different types of retirement accounts. In New Zealand, it is almost limited solely to KiwiSaver. KiwiSaver is an issue for some US citizens as it can result in foreign trust reporting. And along with that, the investments that the KiwiSaver holds can sometimes be considered a PFIC, which is a passive foreign investment company. This can be subject to a high tax rate in the US, and on top of that, very complicated reporting. But the other, I'd say, without going into too much detail, the other 4 major issues we tend to see, or big concerns, is investing in a good manner, it can be very hard as a US citizen to find that kind of sweet spot in the middle, balancing New Zealand tax complications and the US, again, referring back to PFIC. Double taxation on rental property can be an issue. So for a US citizen, Michigan, if you were to move to New Zealand, you kept your home in the US, decided to rent it out, of course, you're going to continue you're going to start depreciating that property. In New Zealand, depreciation is not allowed on a rental property, meaning you'll be paying tax on that rental income and subject eventually to depreciation recapture in the US, which does essentially mean you're being double taxed. Understanding transitional residency is a major concern that we tend to see, both myself and for New Zealand-based tax lawyers. People misunderstanding how transitional residency works, and I'll explain a bit more how what transitional residency actually is in a moment. But people misunderstanding how that works can result in some very complicated and expensive mistakes. And lastly, what affects, I would say, a good 20% of my clients is self-employment tax, or social security tax. For a US citizen residing in New Zealand who's got earnings from self-employment, they're still going to be subject to social security tax in the US. There is no equivalent New Zealand tax to offset, so to apply as a credit against social security, meaning we do need to have a bit of a runaround here to ensure that kind of a tax efficient setup exists and our client is not paying potentially, who knows, a 37% tax rate in New Zealand plus another 15% to the US. But fortunately, there are ways around this.
Okay, yeah, that's super interesting. I was on a lecture the other day about the net investment income tax, which I don't know if you want to talk about that a little bit later, but one of the points was made that if you allow a credit for the net investment income tax because of where it's placed at on the US return, why not allow a credit for the self-employment tax as well? So that to me, I was like, oh, that's an interesting argument there. But we'll get into all of that a little bit later. I don't want to go down too many rabbit holes here. Also, for the folks at home, I will completely agree with David. I think the Kiwi Saver is one of the biggest issues we have. I was hoping in the proposed foreign trust regs there would be something saying, we're going to identify the 15 most common retirement schemes, and we're going to tell you if they're exempt from foreign grantor, non-grantor trust reporting, PFIC issues, all that stuff. Seems like they're still playing with this whole, you've got to meet these 10 requirements, whatever 6 requirements or 5 requirements. It's this really ethereal kind of like, does it apply? Does it not apply? And in my head, I'm like, well, in 2014, you just came right out and said Canadian RRSPs, Canadian RRIFs. You came out and just mentioned them by their name. I don't understand why with the foreign pension stuff, it seems like it's this mission impossible to just tell me about, Australian Superannuation Fund, Kiwi Saver, UK SIP, Mexican Afore. Like to me, this wouldn't be like a mission impossible type task. But let's put that to a side for a second. And I want to talk about one of the things which I think is super important, and I want to make sure we give it enough time in the podcast to this. But it's the New Zealand FIF rules. Can you talk to me like I'm a 3-year-old? Tell me about what does that mean? When does that apply? Why is it so bad? I think it's bad. I don't know. Maybe you don't think it's so bad, but talk to us about that. Tell us what's going on there and why that's an issue.
Well, so the FIF rules. So this stands for the Foreign Investment Fund rules. These are a very, very complicated set of tax rules in New Zealand. These are imposed on foreign investments. So for a New Zealand tax resident, you are subject to tax on your worldwide income. No different than the US, of course. This means that New Zealand will tax you on any investment earnings made outside of the country. Where FIF is particularly unpalatable to many individuals is that you could compare it in essence to a wealth tax. For example, the FIF rules have a few different methods of how we calculate a tax. But first of all, let's explain what a FIF is. A FIF can be any non-New Zealand investment. There are a few funds or investments in Australia, which through agreement with Australia are not treated under the FIF rules. But in essence, the vast majority of foreign investments would be treated as a fifth. So, given an example, we have a client who owns around. I won't go into detail just to ensure their privacy, but they own a greater than $100 million worth of Tesla stock. So this, unfortunately, in New Zealand is treated as a fifth, a foreign investment fund. Like I said, there are a few different methods of how the IRD will require that tech client to report the income from this fund on their New Zealand tax return. The most common method that we see is called FDR. So this stands for fair dividend rate. Now this one is quite straightforward, but it is what you would really say is a wealth tax, whereby 5% of the value of the investment each year is treated as income. So this is, like I say, it's fair dividend rate. So it's essentially treating 5% of the value of the fund as a dividend getting paid to the taxpayer.
Even though it's not.
Exactly right.
Wow.
In the case of Tesla, Apple, many of your tech stocks, they never pay dividends, of course, but they are being taxed in New Zealand as if a dividend has been paid. Now, as this client who we have rightly pointed out, at 5% per year over the course of 20 years, the entire value of their investment will have been taxed in New Zealand. Given the sums involved, they would be at the top tax bracket, meaning they potentially stand to lose over 30% of their investment to a tax bill. Now, the one benefit, on the other hand, with FIF is that it is a final tax, which means there is no other form of tax on this investment as a result. So when we have a high dividend paying stock, well, if you're using this FDR method, you're paying 5% per year. So you're treating 5% of the value of the fund as income per year. Well, if you're receiving dividends that are equivalent to 10% of your investment every year, you're only paying tax on 5%, because as a final tax, it means any dividends you receive or capital gains when you sell are not taxable. Only that 5% each year under the FDR method. There are a few other different methods of fifth taxation. We have CV, which stands for comparative value. This is equivalent in the US to mark to market, opening versus closing value. And there are 5 different methods. We also have the cost method. So this requires a valuation of a private company. The cost method applies when you have an unlisted company.
Oh, okay.
Yes, so even if you have a 10% stock, so as long as it's not a CFC, which is a controlled foreign corporation, so majority owned by that New Zealand citizen, a New Zealand person, then you've got an unlisted company, you have the cost method. Lastly, the deemed rate of return method. This is a very complex formula, and attributable FIF, again, very complex. These last 3 that I've mentioned, cost method, deemed rate of return, and attributable FIF, are extremely rare. You very rarely see any taxpayer choose one of those methods unless the IRD requires them to, which means the usual most common methods, and again, you can choose which method you want to use to calculate the income. Again, either FDR, fair dividend rate, or comparative value. Now, you're probably thinking, I'm talking a very long time, a very unnecessarily complicated tax system in New Zealand, but why it matters is when you have, let's say, Mish, you are moving to New Zealand, well, it's quite possible you may still have a brokerage account in the US. You may have a Roth account, whereby if you continue to contribute to that Roth once you've arrived in the country, it may well be treated as a fifth.
Okay.
Meaning you're going to be taxed on that standing value in the Roth account or your brokerage account every year. Now you're probably thinking, well, New Zealand and the US have a double taxation treaty in place. That surely I won't be double taxed. Well, unfortunately, you will. So let's say, using an example, Mish, you've got $1 million of Apple stock. So it's not paying dividends. Yes, it's increasing in value every year, but you elect to use the fair dividend rate. Maybe that ends up being the most beneficial system rather than the comparative value. So each year you begin reporting 5% of the value of that fund in your New Zealand tax return. You pay tax on this each year, and let's say in 10 years' time you decide to sell. Of course, you'll be subject to the long-term capital gains tax rate in the US, but at this stage there is no foreign tax credit for all of that tax you've paid to New Zealand under the fair dividend rate. Meaning ultimately you could end up paying, let's say, you're looking at somewhere between 15 and 20% on the long-term capital gain. You could end up paying an overall tax of maybe 50% there on the returns really since you became a New Zealand tax resident. And this is a major problem and something which a lot of New Zealand accountants, lawyers, and those in the immigration industry are currently doing their best to convince the government to get rid of this system.
Right, or in some way, shape, or form, because I think your last protocol in your treaty was 2008, right? Your treaty's from 1982, which is old. It's not super old. I guess it's old now. I guess that's kind of dating how old I am. I was born in '79, so but I think that could there potentially be a treaty update at some point in time? I'm not certain. I think I've talked to some folks that kind of know about that stuff. Doesn't seem like there's an impetus to really get something going there. But I'm hopeful that a lot of these things, if they're not solved by legislation, we've got the 2026 model treaty coming up pretty soon. We've got digital assets, which are now a big, big topic that I think all treaties have to be updated for. So there's always hope that we'll deal with this maybe through the treaty at some point in time, especially for the Roth IRAs. You think that might have been cured in the 08 protocol, but unfortunately it was not. Okay,
well,
do you have any concluding remarks on fifth before we move on to Pi? I love the name of these things.
I would say that based on what I hear in the industry, the general kind of winds of change here, I would say that fifth is more likely to be scrapped before we'll see an update to the treaty.
Okay. Well, you heard it here on the Essential Tax Podcast. Fifth's going to get scrapped before there's an updated New Zealand U.S. tax treaty. Okay, let's talk about the Pi tax rules. This almost has, I think, a similar connotation with investments, right? Where we're a little bit worried about. My staff always comes to me, Mish, what do I do with this Pi tax? How do I apply the Pi tax? Tell us about the Pi tax. What does it mean? What does it stand for? Is it good, bad, indifferent?
Well, Pi tax was introduced originally due to the fact that in New Zealand, so if you invest into a managed fund, you are generally subject to a higher tax rate than most other forms of investments. This meant that the managed fund industry in New Zealand was almost starved of cash. So with the introduction of the KiwiSaver system, Pi tax was introduced 1 year later. Pi tax stands for, despite the fact that it sounds like a very nice meal, it stands for Portfolio Investment Entity. So nothing to do with pies, unfortunately. Despite the New Zealand being famous, well, we like to think that we're famous for our pies.
Okay.
So Pi tax is actually quite a bizarre and I might say unnecessarily complicated form of taxation, whereby it is not simply a tax on the income that you generate in a passive investment, but it is income that the fund itself generates from each of the different holdings that it has. So what is a Pi, first of all? A Pi is usually any managed fund, any listed portfolio entity, any index fund, anything which exists, which is set up in New Zealand. It is set up to invest in a number of different holdings. It is not simply just a term deposit, for argument's sake, or a CD. It is a fund which is putting its money in many different places. Now, a fund applies to the government, to the IRD for Pi status. Now, once it attains Pi status, it's treated as a PIE fund. It means that any investors get to be taxed at a more beneficial tax rate of 28%. It can be lower if depending on your income levels in New Zealand, but it will generally be, for most taxpayers, 28%. Now, New Zealand's top tax brackets, on the other hand, can go up to the high 30s. So this is a fairly significant tax saving on your investments. But how PI tax is calculated is actually very complicated. So in order to determine how a fund, so let's say you put your money into a managed fund here in New Zealand, how we determine how that tax is calculated is done on the fund level itself. So that will be all of the earnings that the fund receives from, let's say it invests in 100 different companies, all of the dividends it receives, if it's invested in bonds, the interest it receives, and of course the fund itself will be buying and selling stocks. Now the fund itself will determine what income it's generated for the year, and the PI tax is calculated on this amount. And then it's a simple case of the amount of investors in the fund, the amount of PI tax paid is distributed or is shared amongst the amount of investors, and this then is taxed at whatever their PI tax rate is, which should be 28% in most cases. So this is actually a tax paid by the fund itself, but it is attributable to the shareholder. And indeed, in New Zealand, that PI tax will show on their individual tax return. So where we have, let's say, the comparison to the French net investment tax issue, well, that I would say that PI tax would be an absolutely perfect, perfect type of tax in New Zealand that we could claim against the net investment tax.
Right.
However,
match up 1-to-1 pretty well.
They're exactly the same almost. But the New Zealand and U.S. tax treaty, unfortunately, the clause which saved them, the taxpayers with the French issue was the fact that it didn't refer to domestic tax law in the U.S. Right. Now, New Zealand's treaty doesn't look the same. I'm sorry to say, I don't believe that
the wording in there.
the wording is not the same. Given that the New Zealand-U.S. tax treaty was written at a time of very poor relations between the two countries, so I'm surprised it got over the line at all.
Wow. So that's 82 you're talking about?
Yes.
Okay. All right.
So I'm surprised we've even got a tax treaty.
Oh, really? Wow. I'll have to learn. So just real quick, for the listeners at home, when we're talking about the net investment income tax in France, I think what David's referring to is the Christensen case, and then the predecessor case, which is the Toulouse case, which is setting for those that are interested in the net investment income tax and foreign tax credits, it's setting the world on fire. We have all sorts of countries trying to copy the Christensen case to see if a foreign tax credit, if the foreign tax credit can be applied to the net investment income tax. I think that's always an issue that a lot of countries and a lot of taxpayers have. I have a lot of clients out of Australia and New Zealand whose income tax is paid in both countries wipe out the U.S. tax that's due under the system of credits. But then there's always that leftover net investment income tax. And I've had some people even come to me to expatriate from the United States because they're like, look, I live in Australia, I live in New Zealand, I'm constantly paying this net investment income tax, which is going for the U.S. healthcare and social system, which I'll never use. And I just don't want to sit here and do this for the next 20 or 30 years. I'm going to just give up the U.S. citizenship, and here I am. So great. Any concluding remarks on we now know PI, we know FIF, not good, can't get credits. Any concluding remarks on that before we go into our history lesson for the day?
Well, I would say, despite the fifth taxation seeming like an awful tax on foreign wealth, PI tax might seem again that it is a higher tax system than the US. Of course, as you would know, Mishkin, these are all quite common approaches that foreign countries have to try and keep capital within the country, deter its citizens or tax residents from investing overseas, and instead keep the money in the country. But the one thing I didn't mention, just with PI tax, again, it is a final tax. Okay. Meaning, if you receive any income from your managed fund, if it pays out, a dividend to you, or when you sell, it means there is no further tax because everything is deemed to have been captured through PI, which makes life from a New Zealand tax perspective very straightforward. No reporting on a tax return. The fund is doing it for you. The only real complication is if you own a fifth, then you do have quite a complicated tax return.
Right. And then you have to go into these 5 different options, which the last 3 sounded like transfer pricing to me. And my brain immediately went to transfer pricing. I was like, that sounds a lot like transfer pricing. Okay. So I found this super interesting. I always do kind of pre-meetings with all my guests. And David was kind enough to give me a quick history lesson here. So one of the things New Zealand does not have that the United States does have is a capital gains tax. And David said to me, Mish, New Zealand will never, ever, ever have a capital gains tax. Tell me why you're so adamant about that. Why will they never, ever, ever have a capital gains tax? Can you give our audience, our listeners, a little bit of a history lesson here?
Well, I'm going to save myself slightly there, and I'll say under the current voter base, there will never be a capital gains tax. But the demographics here are changing. They are changing over time.
Okay, all right. So you won't hold your feet to the fire then.
So yes, New Zealand doesn't currently have a wide-ranging capital gains tax. There are instances in where a capital gains tax can be applied, and that is on people who you might say they're flipping houses. But otherwise, it's extremely limited, and it is a completely, almost politically untouchable subject here. Even the very, say, narrow capital gains tax we do have is not even called capital gains. It's called bright line, and that was to try and keep away from the word capital gains tax, but it is in essence a capital gains tax.
Okay.
So New Zealand was founded on, maybe not on the same principles as the United States, but almost in a similar manner. So, of course, the US was founded, or independence came about almost in a way to start a new society away from the monarchs and the kings and queens of Europe, and to start a democracy whereby individuals mattered, individuals had a vote. And this, of course, is hugely prevalent in the culture of the US today. This is also the same in New Zealand. However, New Zealand Kiwis weren't necessarily seeking to get away from monarchies or barons and lords that you had in the UK, but instead to get away from the smokestacks, the tiny little terraced houses in polluted streets of London, and instead to move to a country where there was an abundance of green, clean land. And part of the culture in New Zealand is the right to get ahead. So that particular phrase, to get ahead, is very common, and it means something in New Zealand culture. The fact that you would come to this country and you had a new chance, a new start, where everyone was to have the dream, and this is the Kiwi dream of the quarter acre of land. The quarter acre of land whereby you can progress away from the restrictions that would have existed back in Europe. As a result, the concept of the government taxing you on a capital gain, so on you getting ahead in life, is just completely politically undoable here. It is, you might say the word capital gains tax is, it is as controversial here as proposing a form of communism in Congress in the US.
Right.
Completely unthinkable. Now, even the Labour Party in our most recent elections, they initiated a review into the tax system and the tax base in the country. It was determined that a capital gains tax was needed and that there was a huge amount of untaxed wealth in the country. So again, people purchasing, selling houses, etc. And Labour did go against that capital gains tax, and they ended up living to regret it. There may have been a sufficient number of people that may have voted for this party with a capital gains tax. We'll never know. But why it's now becoming an issue is New Zealand now is starting to move to some of the lowest rates of home ownership in the developed world. The statistics are, they vary depending on the political leanings of which newspaper you read. But I'm seeing figures of somewhere around only 55% home ownership now.
Wow.
Now, when we look then, we've got potentially 45% of the population living in rented property. Well, the idea of a capital gains tax starts to sound a lot more appealing. It does. In addition, New Zealand, since around 2010, 2011, New Zealand has seen record immigration almost every year. There's been some dips, notably 2012 and last year, where we've actually had a not a net population loss, but a population loss of citizens moving overseas. Now, given that we've had record inbound migration, the country simply has not been able to build houses fast enough, and this has resulted in some cases 1,000% increases in house prices. For example, I had a client who a month or so ago who sold their home in Mission Bay. So this is a beachside area in Auckland, the most populous city. They'd purchased their house for $75,000, and it sold for $5.2 million.
Wow.
Now, we are talking 30 years difference there, but nevertheless, there are some significant gains being made. Now, unfortunately for this client, they live in a country without capital gains tax, but they weren't free from capital gains tax in the US. Without any capital gains tax here, there is nothing to offset that US capital gains.
That's the danger zone of not doing your pre-immigration planning or going to talk to David.
Yes, but you saw it yourself, Mishkin. That meal that you referred to back in 2018, we went up to the top of the Sky Tower in Auckland CBD, and I recall pointing out to you, look at this, we have skyscrapers next to little one bungalow suburban houses next to a skyscraper. And this was really that build up in wealth, in untaxed wealth that is occurring right there. Kiwis are very principled about their quarter acre of land, and clearly a lot of these houses refuse to sell out to the developers. But it's a very unique culture here, and it all stems from the original foundation of this country. Not forgetting, of course, the country does have an indigenous population with their own culture and livelihoods well before the Europeans arrived.
Love that. I mean, that's just an awesome story. When you told me that, I was like, we got to get that on the podcast. I think that's so cool. Okay, let's shift gears slightly. This may actually play into what we just talked about, but we have a presidential election coming up here in the United States. The candidates are set. We've got, there's I think one more live telecast where they'll be able to debate each other. We've been here before. You and I have both been here before, right? We've been on. We were there in the 2017 Tax Cuts and Jobs Act, and kind of what happened afterwards. Tell me about your experience when we start getting the elections. You have clients coming to you. Maybe they're thinking about giving up their citizenship, giving up their green card, or maybe other things. What normally happens in the cycle of the presidential election? With people coming to you and the requests that you're seeing.
So it's actually quite interesting. Is I do get an insight into the general feeling amongst either the Democratic or Republican voter base in the US. One interesting fact, and this is not so much relevant to now, but just interesting one, is November 2016 election date. Our website for the company I was employed by at the time, our website crashed for about 9 hours.
Wow.
Due to the visits from the US on election night. Of course, it was a particularly kind of, you might even say it was a meme back in 2016 that, I'm moving to New Zealand depending on the outcome of the election. And our website did end up going down for about 9 hours before our website people were able to put some more capacity up. But yes, we do tend to see a lot of inquiries from the US in election year. So this is pre-migration appointments. People want to know, hey, before I start planning too much, how is this going to look? Is it going to cost me my life savings to move to New Zealand? Now, what's been quite interesting with this particular election, and without expressing any political opinion on it, is the infamous Biden debate, Trump-Biden debate. I was inundated for weeks with inquiries from people with Democratic leanings saying, I want to move to New Zealand later this year. And as a result, I was fully booked with appointments for months planning. Okay, how do we do this in a tax efficient manner? But since of course Joe Biden has stepped aside and it has changed to Kamala Harris, well, I've started receiving inquiries from the other side of the spectrum, which lends to me it is a very good insight into the feeling of people in the US at the moment of which way they think the election might swing. But I am kind of prepared. I've got we've got the capacity there ready come November, that it generally does result in quite a large number of people either side of the spectrum seeking to leave the country, depending on which way the election goes. And that plays out actually very well with New Zealand transitional residency. I do tell clients, look, you shouldn't make a short-sighted decision to leave the country based on a single presidential term. Your life is realistically not going to change very significantly. And if you are irritated by the actions of a particular president, you are still going to be irritated if you're living in New Zealand. So it
Right.
doesn't change
Even
very
so
much.
far away, you can't escape the news cycle, right?
Exactly. You're going to still be following the news. So I do encourage clients not to make hasty decisions based on a single presidential term. So by moving to New Zealand temporarily, which is what a lot of clients end up doing,
Okay.
it does tie in quite well with New Zealand transitional residency. So I can explain a bit more about that if you like.
Yeah, let's get back into that. But one second, I just want to make one quick comment. So, and I don't know if you find this in what your experience, but I've been doing this for a very long time, and I have a lot of people that come to me and try to and then I feel like a psychologist, right? They start telling me all of their reasons. And I remember I was explaining this to some colleagues before, and I'm like, I really don't care why you want to give up the citizenship. I don't judge. And then people are like, oh, you don't care about your clients, Mish. And I'm like, it's not that I don't care. It's your reasons are your reasons. I'm I think it's good that you're kind of trying to play devil's advocate on some of this stuff. But in the end, if I think if a person is that motivated and they want to give it up, that's their decision, that's their right. But what's even stranger though is sometimes I'll do the work. I'll do the exit tax planning work or whatever it is. We'll calculate everything out. We'll put the game plan together, and then we get to the finish line, and about 50% of my clients just say, I don't want to give it up now, or if they're green card holders, I'll just become a U.S. citizen. And it's the strangest outcome to me. I'm just like, huh? I'm like that doesn't comport to what we originally talked about there at the beginning. Do you ever have anything that like that where they kind of flip flop back and forth? And then let's talk about your transitional rules.
Oh, look, absolutely. When a client comes to me, and I do hold a lot of pre-renunciation appointments now, where I'll advise the client on the process, on the steps that they need to take, sometimes push them towards some legal advice. But it is a lot of counseling is involved here. And I'll do my best to remind clients, especially when I feel that they may be doing it for political reasons. And again, for some clients, the prospect of a Democratic presidency is just not something they can handle, and the same with a Republican presidency. But I try to remind clients, how would you feel knowing you can never go back to your childhood home to live there? You can never walk through those streets as somebody who lives in the US ever again. And not just that, is a feeling of a loss of identity. Is that, do you feel American? Are you proud to be American? In most cases, these clients will answer, yes, I am. But the government's making it so hard for me. And I do tell clients, to you really, really take some time and think about this. Is this absolutely what you want? I did have a client a few years ago who was adamant. She wanted nothing to do with America. I'm tired of it. I'm fed up of it. It's so disgraceful that I'm being taxed overseas. And my office at that time was above the US consulate here in Auckland. On the day of the consulate, she came in, she saw me, she was in a celebratory mood. She went down for her appointment. When she came back up, on the other hand, she was absolutely distraught, in tears, and she immediately regretted her decision. So since that day onwards, I really encourage clients to make the decision 2 or 3 or 4 times before they finally email the consulate, because like you say, I do see a lot of kind of people flip-flop between which side of the coin they're on, really.
Hey, quick question to that particular fact pattern you just laid out. In New Zealand, is it your experience you get it done in one day? Like you go in for that one appointment? Because I know some consulates, they do, it's this really weird
London,
like 2-step
yeah.
process. They have this scare appointment, and they tell you to go take a walk for a week, and then you come back, and they're like your best friend all of a sudden when they come back, even though they tried to scare you. And then they complete the paperwork in the second appointment. But in New Zealand, and they're all different, I'm telling you. I've heard people go to consulates in the Caribbean versus Europe versus Africa. Yeah, so in New Zealand, it's just you go in, it's just a one day, one meeting, sign your docs, pay your fee, and you're done. That's typically the process there.
That's right.
Okay.
Yes. So, and I might say that the Auckland consulate has probably one of the friendliest US consulates there is. They're all, and I know most of the staff personally. They're all lovely people down there, and they really do. They know that renunciation is a terrifying prospect for many clients, and they absolutely do their best to reassure people, make them comfortable, and they're a great bunch of people there. But yes, single appointment.
That's great. And so again, if you're going to give up your citizenship, probably one of the friendliest places to do it at would be New Zealand. That's fantastic.
Yes.
Okay, tell us about your transitional rules and kind of how they apply to what we're talking about here.
Yes, so transitional residency. This is what you might even say is a gift from the New Zealand government to new migrants or returning Kiwis. Now, the government clearly is well aware that fifth taxation is very unappealing for a lot of people. If you are Mishkin, let's go back to you. You're moving to New Zealand. Mm-hmm. You don't want to be coming here and getting taxed on all of your US investments in such a punitive manner. As a result, we have New Zealand transitional residency. So this is, as far as I'm aware, unique in developed world. Nowhere else exists apart from maybe some of your kind of countries where you can buy a passport maybe. But New Zealand transitional residency is quite straightforward in how it works, whereby in the first 4 years after moving to New Zealand, you are not taxed on any foreign passive income.
Oh.
So this means it's an excellent opportunity to come to New Zealand, and if it works out as a wise move, which in most cases it would, let's say for a Roth IRA, to withdraw it at that time, pay the 10% early withdrawal penalty on the earnings, and withdraw that fund, bring it to New Zealand during that time. Because after the 4-year period, that would be taxable income here in New Zealand, regardless of the fact that the Roth is paid from post-tax income. It gives you a 4-year opportunity, 48 months, to sell down those investments that you may have in the US. And on top of that, if you have a US rental property, it gives you an opportunity 4 years again to sell that property before it becomes subject to New Zealand tax. And because, of course, like we mentioned at the start, depreciation applies in the US, it means you usually don't end up having a great deal of tax that you've paid on the rental in the US to offset the New Zealand tax bill as a foreign tax credit. So, like I say, transitional residency is unique and unique to New Zealand, and it is an excellent opportunity to arrive in the country and think, well, do I want to stay? Is this definitely where I want to raise my kids or where I want to retire? And during this period, well, you don't need to withdraw all your investments in day one or even before you leave, as you might do if you're a green card holder moving to the US. You've got that 4-year period. Now, where I do see a lot of issues is clients not seeking advice early enough. For example, one thing which catches people out is they file their first New Zealand tax return. They are aware of transitional residency, but they include on the tax return their, let's say, dividends they've received from the US, thinking, oh, well, I'd better tell them about it, but it's going to be tax-free. That's not the case. By reporting any foreign passive income, you're deemed to have voluntarily given up your right to transitional residency.
For the entire 4 years. So
yes.
Wow, just by making a voluntary. Okay, yeah. That's massive.
It's huge. A client then, 6 months later withdraws their Roth of $500,000 and then discovers, oh wait, it is actually taxable here. And that is me and my peers in the industry, of course, my specialization is US rather than New Zealand, but do try and warn clients about that as much as possible. But another key issue, as we tend to see, is the actual start of transitional residency. People sometimes don't realize exactly when their transitional residency has started. Let's say, for example, I've got a client who came out to New Zealand for a month's holiday back in March of this year. It was March or April. Now they're moving. They've decided that they loved it so much they're moving here in November. Now, as you're aware, Mishkin, well, when somebody becomes a tax resident of New Zealand is when they've spent greater than 183 days in the country over any rolling 12-month period. So that month that they are here in April is going to count towards that. So their transitional residency start date is going to begin earlier than they expect. On top of that, if they obtain a permanent place of abode, let's say they arrange a rental property, whilst they're still in the US, they arrive into the country and they move straight into their new home. That would be enough to trigger transitional residency from day one, rather than when they actually become tax resident through days. So this is very important to obtain tax advice. I work with a New Zealand tax residency lawyer, Julia Johnston. So she runs a company called Johnston Law. And I refer a lot of clients to Julia to get that confirmation of exactly when transitional residency starts, because the IRD will not tell you. You only find out when it's too late. So transitional residency is an absolutely excellent thing, but as long as you understand it and get it right.
Gotcha. Wow, those are some great nuggets of info right there. Okay, let's go to another topic along the same vein of presidential elections. So we have the Tax Cuts and Jobs Act of 2017 set to sunset for the most part next year, so December 31st, 2025. Are there any items, any tax provisions you'd love to see come back in? Let's just say they kind of do a modified version of the Tax Cuts and Jobs Act, or maybe they get rid of it and they put in something else. But is there something pre-TCJA you'd love to see come back in? I know, for example, I'd love to see tax prep fees come back into the 2% deduct. The fees they pay to our firms come back in as a deduction. But is there something you'd love to see come back in? And then is there anything you'd love to see kind of get kicked out?
So, given the high house prices in New Zealand, the earnings are high here, but so are house prices. The higher limit for home indebtedness for home debt for mortgage interest deduction would be helpful to see that come back. In New Zealand, having $1 million or $1.5 million mortgage is not unheard of. It's quite common. That would be absolutely great to see that come back, but what plays into very much, this is a very New Zealand specific issue, is the fact that we've been subject to a number of natural disasters over the last 10 years. So we've had a very major earthquake in Kaikoura back in 2016. We had last year, 2023, we had Auckland received 4 months of rainfall in the space of a few hours. Which caused a huge amount of damage. Many, many thousands of people were out of their homes, followed 2 weeks later by a cyclone, which ravaged another part of the country. Now, these were unique. These don't happen very often, but it really goes in. I think you probably know where I'm going with this, is a casualty loss deduction. I would be very pleased to see that come back in its full, exactly how it was prior to the TCJA. Although, for most people here, they have been compensated by councils. If they've lost their homes, the land is now uninhabitable, the council have compensated them. In many cases where we've got, say, farmers, the council have not bought the land, and as a result, they just may have been left with the loss of, many thousands of fruit trees or crops, etc. And seeing that change come once the TCJ, reaches its sunset, I'll be quite pleased for.
Yeah, there's a lot of chatter, not necessarily about that. That's, I think, an unknown issue that someone just has to really raise before other Congress folks. But I think that for TCJA sunset, I think that there will be a lot of movement in that area on like pig butchering scams, things like that. So let's go on to the next question here. So I want to talk for a second about an issue that always pops up, and it seems like a lot of people in the industry, when it comes to New Zealand and Australia, always have this question. there are these things called franking or imputation credits, right? And the question is, are these creditable for purposes of the foreign tax credit or not? Can we apply these? Talk to me again like I'm a 3-year-old. Talk to me like I'm a 5-year-old. What do we mean by a franking credit or imputation credit? And then why is this such a problem? Can we not take a foreign tax credit on this? What's the issue?
So franking credits, or in New Zealand, they're called imputation credits. So these are, as you know, Mishkin, the bane of the OECD, pushing New Zealand and Australia to scrap this system for a number of years, but it's unlikely to change anytime soon. Now, what a franking, or let's focus on imputation credits, which is a New Zealand term. What it actually is let's take a C corporation for argument's sake.
Okay.
C corporation is taxed on its earnings, distributes dividends to its shareholders who are taxed again. So that income is taxed twice. In New Zealand, on the other hand, let's take a New Zealand corporation. It has its earnings. It's taxed at a rate of 28% on those earnings. Now, when that money is distributed to taxpayers, they receive a credit for the tax that the company has paid. So they'll receive that credit basically of 28 cents on the dollar. It can vary sometimes, and they will apply that as a credit on their individual returns, and then pay the difference between that 28% and whatever their marginal tax rate here is in New Zealand, or potentially a refund if they're on a lower tax rate.
Okay.
So it means that the income from that company is taxed only once. Now, I was fortunate enough, but also unfortunate to have a client who did face an audit by the IRS back in 2017, I believe. Now, the IRS assessor had no concept and zero understanding of an imputation credit, simply because this concept doesn't exist in the US. And it did take some time for them to get their head around it. So you're getting a credit for the tax the companies pay, but you should be paying tax on this. And eventually they settled on an outcome whereby the taxpayer was to report the dividend received with no reference to the imputation credit. So this most closely follows the system of taxation in the US. No credit for the tax the companies paid, and realistically, the dividend that the client then went on to receive would have been what they would have got had it been a US corporation and the tax was paid by the company with no credit. This does mean, on the other hand, though, that the tax they've actually paid to the IRD in New Zealand might only be 3-4%, depending on what tax rate they fall into. So there can be a shortfall of foreign tax credit to offset the US tax on those dividends. Because let's say they receive a dividend of $75 and they have an imputation credit of $25. Well, in New Zealand, they're reporting a $100 dividend. They've got an imputation credit of $25. They top it up maybe $4 or $5 to their tax rate. So they're left with, let's say $65. In the US return, on the other hand, what the IRS assessor was quite happy with, or the officer, was to report that dividend of $75, and then only the foreign tax credit for that $5 or $6 that they paid to the IRD could be claimed. Meaning that there is, unless they've got lots of other passive income with foreign tax credits from New Zealand, it was a small amount of tax still to be paid to the US.
I see.
And now this most closely resembles the US tax system. New Zealand and Australian tax system is simply not incompatible, but doesn't align with the US system at all. So, but this is a huge benefit for investing in domestic corporations here.
Yeah, no, it's a fantastic benefit. I wish they could find a way to make it work, to make the credits, again, another area under the treaty I would love to see them kind of look at and resolve. Okay, we're going to run out of time here, but I do want to get into one last topic, which is, we just finished the Olympics here. Fantastic. I thought it was one of the better, at least on the US side. I don't know what you witnessed over there in New Zealand, but I thought it was one of the, outside of maybe some of the weirdness from the open. I thought the opening ceremony was a little awkward, but the whole thing though I thought was well done. I'm applauding France. I think they did a fantastic job. And just watching, I couldn't turn my tax brain off. I would come, after work, I'd sit down. And it was a time in the U.S. where they did a lot of the events earlier, so I'm working while things are happening. So I'm coming in, I'm watching the recaps, and I'm watching people win the gold medals and whatnot, and then I'm seeing them interview the people afterwards, and I'm watching them come up with all these different, grab bags and things like people are just given to them, and they're doing influencer things on social media, and you can tell they're getting paid. And in my head, I'm like non-cash income, influencer income, and I'm thinking about like all these young athletes that if I'm the IRS, I'm literally just keeping like a check mark, like, oh, that's a nice little Fendi purse that you got for winning a gold medal. That's, and you're thinking, are they reporting all of that, that influencer income properly, the non-cash stuff properly, the advertisements that they're doing afterwards. Not all of these people are professional athletes. Some of them are still going to college. They're young people. In the United States, we don't have like a tax on winning. Some countries pay if you get a medal, right? We don't have what's called a victory tax here in the U.S. So you win a medal, you get a cash prize. We're not going to tax that. But talk to me generally speaking about your what your thoughts are on the influencer tax, this new age influencer tax. Maybe potential cross border issues, U.S. New Zealand, just general thoughts.
Well, New Zealand's approach to new forms of income very much aligns with the country as a whole. The pace of life here is slower. There is a very much one common phrase here is "she'll be right," which basically means we'll work it out.
Okay.
And as a result, the IRD here can be very slow to recognize new forms of income occurring in the world and to address them. Some people thought the IRS was very slow to address NFTs. Well, New Zealand is even slower to address these issues. Now, there is actually very little guidance in New Zealand, and it is very much a discretionary tax system where the IRD will assess the income and make their own call. Rather than being a set tax code, they will make their own call of whether this is income or not. Now, when it comes to prizes of, let's say, New Zealand won a lot of gold medals, the highest or the third highest in the world per capita. Obviously, Dominican Republic, I think, got number one because they've only got a population of 60-odd thousand. But New Zealand did very well.
Good.
Although we were all very annoyed that in the closing ceremony, New Zealand was missed off that map. It finished with Australia. It didn't exist. Common problem. We get forgotten off maps.
Oh, no.
No, New Zealand doesn't have a tax as such on prize winnings, unless it is deemed that services have been performed. Now, looking at the case of an Olympic athlete is not necessarily performing a service in any manner that you might compare to being a sole trader or an employee of the Olympics. However, on the other hand, let's look, which would mean the prize winnings any prize winnings they received would be generally tax-free because it's not an employment or business relationship.
Okay.
Now, on the other hand, let's look at the All Blacks, the famous New Zealand rugby team.
Right.
They go around the world winning trophy after trophy, many World Cups. This one could be argued that they are providing a service to Rugby New Zealand. Rugby New Zealand or New Zealand Rugby, are going on and selling those TV rights, as are the International Rugby Organization, which runs for profit to reinvest its profit anyway. Now, in this case, the prize winnings, would likely indeed be deemed as taxable by the IRD authority, the IRD here in New Zealand. So there is a bit of a mixed bag here. Gifts, the receipt of gifts is tax-free in New Zealand. So in the case where you've mentioned, these Olympic athletes receiving these, Gucci handbags and high-tech, technology from sponsors, that may well be tax-free in New Zealand unless it's deemed that any services or any business relationship exists between the two parties where there's an expectation of services to be performed eventually. With regards to influencers, though, let's take the infamous Reagan as an example, the Australian breakdancer.
Okay.
Now, in the case, let's say Reagan releases a video on TikTok addressing the concerns, the bullying that you might say she's faced. If that had 50 million views and it was monetized, she received money from TikTok. Let's say this was in New Zealand now. That would generally be tax-free in New Zealand because there has been no active intent to go out there to generate income. But now let's say Reagan got 50 million views, she made some money and thought, I'm going to make another video now and say a bit more and know that I'm going to continue getting these views. At that point, there is active intent to go out there and earn income, and it becomes taxable from that stage onwards. So in New Zealand, go viral once, you're totally fine. Go viral again, where the intent was to go viral, you will begin generating taxable income.
Okay, fantastic. And side question here. Now, are you an All Blacks fan or are you a Red Roses fan? Which are you? Do you have a certain rugby team, rugby alliance here? Are you Britain? Are you New Zealand?
It'll always be my home country, Wales.
Okay,
always
Wales. Okay.
Yes. It does make things complicated when Wales do play the All Blacks. I should be there in an All Blacks shirt, but no, I've gone there as a Wales fan and will continue to do so.
Yeah, that's okay. I live in Dallas and I'm a New York Giants fan, so I kind of know what you mean. I'm the only one sitting there wearing my Eli Manning jersey in the Dallas Cowboys football stadium. It's kind of like sacrilege to do that in the Dallas Fort Worth area. So
it's almost embarrassing, isn't it?
Yeah, it's tough. It's real tough, and our
painful.
Team's not very good right now. So, okay. So just to conclude here, so David, it's been fantastic. There's probably a million more tax questions and scenarios I could throw at you and could come at you with, and certainly definitely want to have you back on the podcast and sometime in the near future. Some of the stuff we talked about today, though, you're gonna send over some links. We're gonna link that to the show notes. Is that correct? Great. And
yes.
Then just to conclude, and I always ask this to folks, if people want to get in touch with you, they want to work with you, I assume you're going to send over some links about how that's done. But talk to me just for like 2 minutes. I want to work with David. How does that work? Do I got to get on your calendar? Do we got to do like a 30-minute call? Do we engage immediately thereafter? Like, what's the best way to work with you if I'm going to work with you?
Well, one of the key focuses of our company is due diligence, ensuring that we fully understand the client's circumstances before we even suggest that we can help. So when a client reaches out to us, the very first step of the process is we will assess exactly what assistance they need and ask them to complete a very basic questionnaire. New Zealand, as we might remember from the Panama Papers, has some of the strongest privacy laws outside of Switzerland, meaning the information provided to us is, first of all, subject to confidentiality privilege in the US, but extremely private here in New Zealand as well. So once we receive this questionnaire, at that stage, then if they're looking for tax return preparation, we will offer them a fixed fee quote. Okay. If we take too long on a tax return, that's our problem to deal with. Or, of course, for tax advice, we will set up a time. At the moment, we must have had some good press somewhere because we've been, we're fully booked around 2 weeks out at the moment for appointments. So we're generally not running, say, intro calls at the moment. We are running straight to the questionnaire and book a time in. But if a client wants to get some advice, wants some assistance with their tax return, or just wants to check some questions, the very first step is I would recommend submit an inquiry on our website. If you listen to the podcast, absolutely, let us know. It'd be great to hear. And we can take you through the next steps to ensure we understand your situation fully, any advice you receive is accurate, correct, up to date, and then get further underway with the process.
Fantastic. Well, look, David, so nice to have you on here. Super excited for the U.S. tax team in New Zealand. I'm actually hoping there's some massive change here in the U.S. for 2025, 2026, because that means I may be able to get back down to Australia and New Zealand and come see you, and we can go back to that tower and have another meal and hang out and talk more tax. Thank you so much again for coming on. We really appreciate it.
Thank you, Mishkin. It's been an absolute pleasure.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.